everybody, today's April 4th and we're going to do a video from here down in Ecuador. We've been out exploring a little bit while we're going to the market. We're still on curfew from 2 p.m. to 5 a.m. But one of the topics that we've had a lot of requests for was to explain to everybody about the financial process of getting to where we are today, I retired at 52, Julie's at 45, and how we're funding our retirement. First off, it was a team effort. I did a lot of the investing part. Julie did the day-to-day, taking care of the expenses and finances. I'll let Julie talk about the initial part of our budgeting to get here and her thoughts on the matter, and then we'll go into some of the investing ideas and in ways I helped to steer to guide our finances to be here today.
Well, to begin with, Warren and I don't have any vices. So we don't smoke, we drink a little bit, not much, for me, very little. And so therefore our budget for that is minimal. We lived on about 80% of our income. We put away 20%, and that was toward our early retirement. And I kept a balance sheet. Everything that we spent, I tracked. We lived very well within our means. And as far as our homes, we lived modestly. Some people would say, well, you had a beachfront home. Yes, but we bought a home and we fixed it up. My kids, much to their chagrin, lived through many remodels because we would buy a home and we would fix it up and then we could sell it. And then once the money was made back on that, it went into investments, and Warren has been quite savvy when it comes to that.
Okay. And so let's go ahead and talk a little bit about where we are as far as investments, the investments and the strategy I followed to get here, and then what we're doing today. And so let's go ahead and start with those topics. So let's talk about investing money and things that I did over the last decade to get us here today. First off, the time period we're in now, the stock markets are doing horrible. The S&P is down, the Dow's down, the NASDAQ's down. Most investments are way, way down. Currently, most of my early retirement portfolio is in cash, and the majority of my early retirement portfolio is not in the stock market. I had moved back in July the majority of my early portfolio into prosper.com and lendingclub.com and fundrise.com, and we'll discuss each of those. And I had about 20% exposure with dividend stocks in the early retirement account. But before I had the money for the early retirement, I had to make money grow. And right now we're in a time period that's probably a very good opportunity to follow some of the strategies I did over the last decade through the bull market, because the stock market right now, due to the coronavirus, is so beaten down that a little aggressiveness now can pay a lot potentially back in the future. Now, one thing I want to make clear is I'm not a financial advisor, and some of the stuff I'm going to tell you that I did is not going to be recommended by the financial advisor that you use. I want to make sure that you understand that I am not going to be responsible for any investing that you do. I'm just going to tell you what I did, and it's up to you to make your own decisions. If you don't know anything about investing and you're starting off from scratch, there's a great book that's by Tony Robbins. Unshakeable by Tony Robbins is a great book. I had it on Audible. It was great to listen to. I wish this book was written 10 years ago. It would have saved me from a lot of mistakes. If you know nothing about investment, please read this book, listen to this book. I even offered my son $25 to listen to this book. When you're investing for early retirement, you have to ask yourself, when is enough enough? What do I need to be happy? How am I going to have this money continue to come in and support my lifestyle? What are my goals? Julie and I, we decided that we were going to live below our means so that we can get to where we are today. We didn't try to keep up with the Joneses all the time. We've lived that lifestyle where you're trying to keep up with somebody else. And as your income grows, as your circle of friends grow and their stature and the money that they make grows, you find yourself wanting to expand what you're doing. And you don't want to find yourself in debt. You want to make sure you're not carrying a bunch of debt and that you're able to do most things with cash. And when you're able to start paying everything with cash, you're not having to pick up all that extra interest and penalties. But I've got friends out there that are going to be working into their 70s. And I've got friends that are currently very wealthy and successful working in their 70s. That's what they want to do. And there's nothing wrong with somebody that wants to work forever. I don't want to say maybe that I'm not really retired, but I'm doing what I want to do now. I want to be happy. I want to travel. I want to do videos. I want to be able to help animal causes and go visit people in different places and try to make the world a better place and be a great ambassador for the country. That's what Julie and I are really wanting to go out and do, is focus on trying to make the world a better place. Now, because I followed stock news and investing news and looking at different things because I was excited about investing, I was able to get in front of some things. I was an early investor into the Canadian marijuana cannabis stocks. So I made a good amount there. I got into Roku when it was early. I got into Beyond Meat when it was early. But I also learned not to get married to a stock that when you get to a certain point, you take some profit and take it off the board. I took some losses in the beginning. So you have to learn to find a place where you want to get out and follow your initial guidance. If that was enough at that point, get out.
So the NASDAQ, the S&P are both down over 25%. The Dow is down over 28% at this point, almost 30%. It's bounced up a little bit, but it looks like the lows may be tested again. And instead of these being ugly charts, we can look at them as being opportunities, because when these stocks or these indicators are down 25, 28%, 30%, that means if you were to be able to get in near the low, knowing that eventually these indicators are going to go back up and make new highs at some point, that's a 35, 40% upside. So instead of looking at this as a 25% downside, let's look at this as a 35 to 40% upside potential.
So there's a group of stocks out there that during the bull market run, I was investing in somewhat heavily. They're triple leveraged, and many of your financial analysis or financial advisors out there are not going to be on board with going this route. You need to really pay attention to what's going on in the market. And you want to be able to make sure that you are keeping your pulse on what's going on so that you don't take a huge loss overnight. But when you're in a triple leveraged stock, you're going to get triple the return of that sector or that category of investment. There's triple leveraged against the Dow, triple leverage against the S&P, triple leverage against the NASDAQ, triple leverage against technology. You got triple leverage on China, on Russia, defense. So you have different ways of investing. And if you think a sector is going to be doing well and you get into that sector where it's a bucket of stocks and you're getting triple the return on the stock, you're going to make out. So if the stock market went up 10%, if you were involved with a stock that was triple leverage against the Dow, for example, that's going to give you a 30% return. Conversely, if the stock went down or the Dow went down 10%, you would lose 30%. So in these days of the coronavirus crisis, these stocks have gotten pummeled. They're way, 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 way down. That said, with the stock market being down over 30%, 35%, you have the potential, if you're timing the market right and you're looking for the up signals, if you get into these triple leverage funds during this down cycle, by the time the market gets back up to where it was, you'll have about 100% return by being involved in these triple leverage funds. So I'm looking at this right now as an opportunity to take some of the cash that I have on the sidelines. When I start to feel as though the cycle is going to start reversing, I'm going to start putting some money back onto the table. Might not do it all at one time, but in increments. I don't want anybody to follow my advice because I'm giving it. I want you to make up your own decisions. I'm not your financial advisor, and I'm not going to be responsible for any losses you make. I just want to make sure you know how we got here. So I made a lot of money over the past decade with stocks like TQQQQ. It's going to be TQQQ. UDOW, which is UDOW. Also was involved with SPXL, which is triple leverage against the S&P. So let's look at these stocks.
So the 3 ETFs that we're going to discuss are triple leveraged. And so we're looking at SPXL first. It's currently at $23.11. And at one point it was at $76.33 a share and got all the way down to $16.51. So it's come back up a little bit. When we look at TQQQ, it's at $42.42. And at one point it was all the way at $118.80. If you were holding all the way down, you would have lost a fortune. So getting in when they're low and riding them back up is an option now. The UDOW at $36.72, where it was previously at a high of $137.44. If you're able to get in at the low point, we're able to then potentially get back up to these highs. I'm not giving the thumbs up to buy, and I want you to make your own decisions. It's quite possible we're going to hit the lows again. Keep your eye on the market. When things start to recover, things start to turn around, and the market starts to go back up, you want to be riding these markets, and this is a good way to do it.
So Fundrise is a place where I've got some money allocated. Instead of me owning properties where I've got to worry about maintenance and collecting rent, I've got money in Fundrise, and they own a lot of properties around the country and in different areas, and there's different types of funds that you can be in. You have funds that are based more on giving you more appreciation of the value of the property that they're holding. You have funds that are going to pay you more in dividends. Instead of you getting the appreciation, you're getting a dividend payment on a regular basis because you're getting a portion of the rent that's coming in on all of their properties. I'm angled and in position more to receive the rent part of this. Now, because of the coronavirus, I will tell you that I've noticed that in the month of March, I was making about 23.5 cents a day per $1,000. And as of April starting, I've seen that fall down to 17.5 cents a day per $1,000. And so, depending on how this coronavirus plays out, if people aren't paying the rents, it's going to decrease the amount of dividend I make. But if things go the way they should and recovery comes back around, I would anticipate I'd see that 23 plus cents again at some point. But what that breaks out to is somewhere between 6.5% and 9.5% a year in dividends is what I'm somewhat expecting to see coming from the funds that I've chosen to be part of under the Fundrise portfolios.
So Income REIT is one of the funds I'm involved with, and you can see it's spread out amongst 19 different properties. I'm actually in about a half dozen different funds. So this is the return that you're looking at, and you'll see that the amount on dividend is where this one is focused, and that's my concern, is trying to bring income in. Some of them have a higher appreciation value in the property and have a blend and an even mix. These are the average returns of the portfolios over the last 6 years, and so you can see they're quite attractive.
Another area where I'm invested is in peer-to-peer lending. I'm making a pretty good amount coming out on interest each year out of Prosper and Lending Club. However, right now I'm positioning more of my money towards Prosper than Lending Club. Reason being, Lending Club had some changes in the way that they're set up, and I'm a Floridian, and in Florida now you cannot invest in lending club. I'm not quite sure the reasons why, but because of that, when money is coming in from lending club, I'm just switching it over to Prosper. So with Prosper.com, it's a peer-to-peer lending. Somebody wants to borrow $5,000. I'm going to give up maybe $100, $125 of that. You can do as little as $25. If you want to be part of a peer-to-peer lending platform, the minimum towards a loan is going to be $25 that you would give. So it's going to be a group of people providing this money to this to a person that needs the money. Now, there are defaults that happen and bankruptcies happen, and not everybody pays their bills. And that can happen in this downturn with coronavirus as well. So I don't know if the return I'm seeing right now, where I've been averaging about 9.5%, is going to continue if we have a lot of people that are unemployed, and that might fall a bit. So I'm going to have to taper my expectations a little bit on what I'm going to be anticipating coming in from Prosper and Lending Club over the next few months until we get back to a sense of normalcy, because there could be a downturn in people paying their bills. But I was receiving about 9.5% on average, and my strategy there is not to always go towards providing loans to those that have the best credit. I've looked at the C and the D credit areas, where a lot of these folks are taking out 70%, 18%, 19% loans for 3 to 5 years. And I would invest in those folks and help them to get the money that they needed, knowing that there would be some defaults that would come out of this. I would still come out ahead. So if 17, 18% was my expected return after the defaults and people going bankrupt or people not paying their loans, I'm receiving about 9.5%. Now, my experience is not necessarily going to be what you see. Every mix can be a little bit different, but this is what I've been experiencing so far.
So as I mentioned, Florida is one of the states where Lending Club is no longer allowed to have investors come in from. Again, I'm not quite sure of the reasoning, but you'll see I was receiving a 9.56% return on the portfolio that I had through Lending Club. Now the money that's coming in, I'm sending to Prosper. Prosper, I'm currently receiving a 9.38% return. I invested my first $1,000 in Prosper back in 2006. I wanted to give them a try and make sure that they were a viable source of income. I chose to go with the higher risk category of investing to get a greater return. I very rarely invest in the type A types of investors. You'll see here I had a $38,000 come in interest, $16,000 plus in losses for a $20,000 gain. Like when you're paying on your car, the amount that you owe and the amount that goes towards interest goes down. Your older loans, I'm receiving a 7.5% return. As money's reinvested, it's averaging over at 9%. So if you put in one lump sum, you might watch your overall return start going down as the loans get older. I have my auto reinvest on right now, so currently I'm averaging over 9.38. However, if it was just the older loans, it would be about 7.5. So you can see from how this little graph works that you get paid less on the older loans.
We hope you have enjoyed this video and that you have found it to be useful and that you can utilize some of the information you have heard today in your lives. And you know, it isn't bad being retired at 45, and I'm sure it's not too bad for him at 52. And I know there are many people
I would have liked to have been 45.
I know there are many people that are envious of us at this point, except for the fact that we are quarantined here in Ecuador, but hopefully that will come to pass. So please remember to subscribe, and we look forward to you seeing us in the future.
Yeah, and also don't forget to leave a comment if you'd like to. Also press that like button. And as a reminder, I'm not a financial advisor, and anything you choose to do is something you do on your own. I'm just telling you what we did to get here, so you're on your own, and good luck.